Let's start with something most people won't tell you. Penny stocks under $1 are not cheap. They are distressed. When a stock trades below $1, it usually means the market has lost confidence. Maybe the company diluted shareholders. Maybe revenue collapsed. Maybe debt piled up. Maybe investors simply stopped paying attention. But here's where it gets interesting. Sometimes, not often, but sometimes, these beaten down stocks represent early stage companies trying to survive a rough period while operating in industries that are still growing. And that's where asymmetric opportunity can exist. The reality is this: 7 out of 10 penny stocks fail. Some get delisted, some reverse split repeatedly, some disappear entirely. But a small percentage recover, and when they do, the gains can be dramatic because they are starting from such a low base. A move from $0.50 to $2.00 is a 300% gain. A move from $0.30 to $1.50 is 400%. That's the math that attracts aggressive investors. However, serious investors don't blindly buy low-priced stocks. Now they ask, is the company still operating? Is it listed on a major exchange? Does it have real filings? Does it have enough cash to survive? Is there a realistic catalyst ahead? In this video, we are not talking about random OTC shells. We are focusing on companies that are still active businesses, operating in sectors like clean energy, biotech, enterprise tech, and industrial systems. They are risky, they are volatile, but they are real, and that matters. Now, let's move into the first company, one operating in the clean energy and EV infrastructure space. Let's talk about Nuvve Holding Corp. Nuvve operates in vehicle-to-grid technology, often referred to as V2G. Here's what that means in simple terms. Electric vehicles have large batteries. When connected to smart infrastructure, those batteries can send unused electricity back into the power grid. Instead of just consuming electricity, EVs can store and redistribute it. That concept becomes powerful when renewable energy expands. Solar and wind are intermittent. The grid needs stability. Energy storage becomes critical. Nuvve's technology attempts to position itself in that intersection. EV adoption plus grid stabilization plus smart infrastructure. Now, why is this stock under $1? Because small-cap clean energy companies often struggle with scaling revenue, managing cash burn, raising capital without dilution, competing against larger players. The clean energy theme is massive, but small companies inside massive themes don't automatically succeed. The upside case: if EV infrastructure investment accelerates or if partnerships expand, small players like Nuvve can experience rapid price movement simply due to low market capitalization. The downside case: cash runway concerns, potential dilution, slow adoption. This is a high volatility clean energy infrastructure play, not a stable utility stock. Investors here are betting on sector growth plus execution. And with penny stocks, execution is everything. Now we move into biotech. And biotech penny stocks are a completely different animal. Forte Biosciences is a clinical stage biotech company. That means its value depends heavily on research and trial outcomes. Biotech stocks under $1 are often there because a trial failed. A drug candidate disappointed, funding became tight. Investors lost confidence. But biotech is unique because a single positive catalyst can completely reset valuation. A strong clinical update can double or triple a stock in days. However, the opposite is equally true. Clinical failure can erase 60 to 80% overnight. This is why biotech penny stocks are often described as binary bets. You're not investing in current profits. You're investing in scientific progress and probability. When analyzing a company like this, investors look at cash on hand, pipeline focus, upcoming trial timelines, institutional ownership, insider activity. If the company has enough runway to reach a key milestone, speculation increases. But if cash runs low before data arrives, dilution risk rises. This is not a conservative investment. This is a high-risk, catalyst-driven speculation. And that's exactly why some traders watch it closely. Next, we look at Brand Engagement Network. This company operates in digital human and enterprise interaction technology, essentially AI-powered digital engagement tools. Enterprise technology is competitive, very competitive, but small-cap companies sometimes carve out niche positioning. The appeal here is exposure to digital transformation trends. Corporations are increasingly automating customer interaction. Digital avatars, virtual representatives, and automated systems are expanding. The question is execution. Can a small company secure contracts? Can revenue scale? Can operating expenses be controlled? Small enterprise tech firms under $1 often face valuation compression after early hype cycles fade. But if they demonstrate traction, sentiment can reverse quickly. This is a momentum-sensitive stock, news-driven, volume-driven. If contract announcements occur, movement can be sharp due to smaller float and lower liquidity. But without traction, sideways or downward drift is common. This is not a guaranteed growth story, it's a speculative enterprise tech turnaround story. Finally, we look at Semilux International. Unlike biotech or enterprise tech, this sits in the industrial and specialty lighting space. Sometimes, investors overlook industrial microcaps because they're not flashy. But niche manufacturing companies can surprise markets if contracts increase, margins improve, operational efficiency improves, industry demand, cycles turn upward. Industrial penny stocks tend to move less on hype and more on revenue performance. However, they also face challenges. Scale limitations, thin margins, customer concentration risk, liquidity issues. What makes microcaps volatile is small market capitalization. It doesn't take massive buying pressure to move price significantly, but it also doesn't take massive selling pressure to drop it sharply. Investors watching stocks like this look for revenue consistency, balance sheet stability, insider activity, sector demand. This is not a momentum hype stock. It's a small cap industrial speculation that depends on operational performance. All four of these stocks share one thing in common. They are under $1 because the market is uncertain about them. Uncertainty creates risk, but it also creates potential opportunity. Serious investors treat penny stocks like optionality or small exposure, controlled downside, potential asymmetric upside. You never assume success. You manage risk first. You let catalysts determine momentum. Because in penny stocks, survival comes before growth. And growth, if it comes, can be explosive.